Keith, it's pretty amazing. We've come off record closes again for the S&P 500 and the Dow. Is this a market that you feel is still constructive enough for people to remain investing in?
Well, first of all, great to be with you as always, Dom. And the answer is yes. And we typically look at the next 12 months. And when we look at that, we have an economy that's only about a year into this expansion. The average expansion is about 5 years. And the bull market, in our view, is very much intact, supported by just, great earning trends as a whole. We are in a transition, right? This is the second year of a bull market. So far, the volatility has been low. Typically, you see somewhat higher volatility as you move towards the second year of a bull market. But overall, if you have an economy that's sound, you have earnings that are solid, and you still have a favorable, monetary policy, even if it becomes incrementally less so, I still think that's a good environment. But the reality is we're not going to move at 100% up like we've done over the last 18 months.
Yeah, I mean, since the pandemic lows, the S&P has roughly doubled in value at this point now. It can't go on forever. We get that. But there hasn't even been a pullback. There's been no inkling of anything of that sort. We always talk about how Federal Reserve and interest rate policy tends to be the thing that really ends these bull runs throughout the course of history. Do you expect that the pressure is now on the Fed to do something where policy can be normalized, but then not derail the market?
That's right. Typically, a Fed's change injects volatility, just like a peak in growth in the economy tends to inject volatility. But really what tends to end the bull market is moving into a recession. And right now, we think the economy is on solid footing. Look at the consumer. There's still a lot of excess savings. The debt service ratios to service things like even mortgages right now is at the lowest level in about 20 or 30 years as a whole. So there's still pent up demand as a whole. So, and then businesses are actually on firm footing. We've seen a lot of business equipment spending. And right now, inventories are so low, which is a boring topic, Dom, right? But we have to rebuild those inventories, which continues to support the overall economy. So again, we think things are on solid footing, but you should expect, by definition, a moderation in the move upside. And a lot of the action we're going to see in the market is likely below the surface, not just at the headline index. And that's why we're finding more opportunities in some of the cyclical areas where people have almost given up here more recently.
I don't think it's boring at all. I think that's exactly what investors and traders are trying to figure out right now, Keith. So where then exactly are the opportunities? I mean, is it going to be those value pandemic kind of plays that we've seen over the course of the last year take us higher? Airlines, hotels, consumer discretionary? Is it a return to big technology companies and communication services? Where's the outperformance going to be? Where's the leadership?
Yeah. So the first thing, I do think it's more of a balanced overall outlook relative to last year, where you're finding opportunities in both growth and value. We still lean for the next 12 months more on the value side. Simply, if you think about it, we've seen this kind of back and forth stealth rotation within the market. Technology outperformed by about 18 to 9% over the last couple of months. We think that leadership by tech is unlikely to continue. And after liquidation and after somewhat of a give up, we think that the move back into value has some sustainability. So we like specifically the financial area. And as yields slowly rebound, that should help out. They're really cheap. Dom, an interesting statistic right now is the growth area is trading at about a 30 multiple on a forward basis. The value area is about 16, so it's relatively cheap. And I think people are too concerned about this peak growth phenomenon, which we think peak growth isn't weak growth, and that should continue to support more of the value side of the market.